How to rebalance your portfolio as an investor as you age. We investors usually talk about consistently investing in financial products, which is a very good thing to do. It's a very good habit to have. But investment is not just about growth. It is also about protecting what we have built over the years. For instance, how a 20-year-old will approach investment in financial market should be different from how a 50-year-old will approach the market. This is because they perhaps have different time horizons, they have different financial goals, and among other things. So in this video, I am going to share with you why rebalancing your portfolio as you age is very important and how to do that. What is a portfolio? Think of a portfolio this way. Think of it as a basket containing different kinds of fruits. Let's say we have mangoes, we have bananas, and we have oranges. These fruits are in the basket. Maybe the owner of the basket likes them because of their tastes, likes them because of their nutritional benefits. They are available in his or her environment, and maybe they are affordable. That is why they are in the basket. So that is how a portfolio in finance also looks like. It's a basket containing different kinds of financial products. It could include individual stocks, mutual funds, bonds, treasury bills, and so on. And these kinds of financial products are in the basket because of different factors. It could be due to your age, your financial goals, your income, and other factors. So in this video, I'm going to talk about different kinds of individuals based on age group and what a typical portfolio of these categories of individuals based on their age should look like. The first category of age group I want to talk about is between 18 years and 29 years. I know at this age, most of us perhaps are in school and may not be earning income. But in my previous videos, I mentioned that most of the financial products we can start with at least as little as 100 Ghana cedis. That means that even if you are not working but you are still in school, you can still start with the little available to you. So what is interesting about this age group is the fact that there is so much time ahead of you. And if you start early, you will experience the benefits of investing in the financial markets. That is why it is good to start early. At this stage, you can hold a portfolio that could have at least 80% invested in relatively high risk financial instruments like individual stocks and also mutual funds that invest heavily in the equity market. Why? Because you have enough time to allow the market to grow your money. Another thing is that you can learn and adjust as time goes on. And the fact that even in the short run, if the market is not doing well, the market still has time to rebound. So that is why it is important to hold a portfolio such that a significant share of it is invested in the equity market, which is relatively risky and also has relatively higher returns as compared to other financial instruments. So there is time for you to allow your money to grow. However, it doesn't mean that because it is good to take risk at this level, you should invest in financial instruments or financial schemes that are not legitimate or that you do not know the source of their activities. No, it means that you can take calculated risk by investing in financial instruments that by design are relatively risky and also have relatively higher returns. So it is at this stage, you have more time ahead of you as compared to somebody who is 50 years old. So that is why we advocate that investors should start as early as possible. The second category of age group I'll talk about is those between 30 and 44 years. At this age group, it is no longer about just growth. Stability is also very important. So because at this age, probably you might have started a family, you might have started a building project, school fees, and other things that are perhaps recurrent in nature. So it means that you can no longer invest like an individual who is 18 years or 20 years. So how should your portfolio look like? Perhaps you can reduce your portfolio to maybe 50% to 60% equity so that the rest can be invested in financial instruments like maybe bonds, treasury bills, and other relatively liquid financial instruments. The third category of age group is those between 45 and 59 years old. So at this stage, the important thing is what? Protecting what you've already built over the years. This is not a time to go strong in the equity market because of short-term volatility. And over the years, we've experienced these mistakes from investors, especially in Ghana, where a lot of individuals near their retirement invest heavily in the equity market. Then once the market goes down, they lose almost everything. They lose everything that they have spent years building. So at this stage, don't just look at the interest that companies are or the financial instruments are promising. And that is the mistake that most individuals or investors make. They only look at the interest that these financial products are promising without looking at the corresponding risk that they carry. So at this stage, time is not on your side, and what you should do is to invest rather heavily on money market financial instruments. So what should a typical portfolio look like? Maybe you should do 35 to 45% equity, and the rest should be invested in mutual funds or and money market funds that are relatively liquid, such that you can have access to your money as and when needed. So you do not need to go strong in the equity market because of short-term volatility, and you need to protect what you have spent years building rather than trying to gain so much in the market and end up losing the capital that you have spent your years building. The last category of age group I will talk about is those who are in the bracket of 60 and above. At this stage, most of us are retiring or near retiring. So that means that at this stage, what we need is to preserve our capital, preserve what we have spent years building. This is not the time to invest heavily again in the stock market or the equity market. So in fact, at this stage, unless you want to will it out, it is not advisable to hold more than 15% of your portfolio in the equity because it will be difficult to change it or to convert it to cash as and when needed. And at this stage, you may need cash, ready cash for many reasons, including health and others. But one mistake that most people, especially people in retirement, make in Ghana is the fact that we still want to invest in assets that are difficult to convert to liquid. And in most cases, it poses so many dangers, especially to retirees. We've heard of stories where people take their retirement money and they want to build houses to rent. Of course, if you have the money to do so to completion, it is okay. But to the extent that you cannot complete and you want to start, or you start and get stuck on the way, it is not a good financial decision. That means that you may be forced along the way to sell the uncompleted structure. And in most cases, you are likely to sell the asset an amount less than how much you spend building it. So at this age group, what you need is assets that are liquid in nature or near liquid, such that you can have ready cash as and when needed. So this is how a typical portfolio of a 60-year-old and above may or should look like. Not more than 15% in equity, and the rest perhaps in money market funds and in cash. In summary, a typical portfolio of a 20-year-old should not be the same as a portfolio of a 50-year-old or a 60-year-old. As we age, we need to rebalance our portfolios such that it will help us preserve the capital we have spent years building. If you have found this video helpful, don't forget to like, share, and subscribe. Thank you, and I will see you in my next video.